Hey guys, this is Bruce with Simpler Options doing the free video over the weekend with the outlook for Monday. What I wanted to do was to look at where we've been over the last week and throw out an idea for you. Basically, you guys know that we've had just a strong move up here off the bottom from a week ago. Last week in the S&P, we were down around 1860, 1870 on terrible non-farm payroll numbers. Turned around and moved, ripped to the upside about 8%, 130, 140 points in the S&P. We have 9 straight days in a row closing higher in the Dow, as I'm looking here, and I think 8 out of 9 days closing higher in the S&P. So what do I think that means? Well, we've moved a tremendous way on bad data, on anticipation of the Fed. Maybe the Fed prolongs doing what they're going to do, or, possibly there's some quantitative easing or something coming down the pike, which I don't think will happen. So what I want to do, although I'm bullish, I'm bearish in the short term. I think this thing stalls out, reverses a little bit. So I wanted to set up a trade here to kind of take advantage of some potential downside in the next week or two. Now also, don't forget, we started earnings this week with Alcoa, terrible numbers. The earnings that have come out so far are not good. We get into all the banks next week, so if those numbers aren't spectacular, we could see some downside. So I want to set something up to take advantage of that, and I want to show you kind of what I'm thinking about. So I'll go here to the SPX. I compared the SPX to the index, to the Russell, and to individual stocks as well. There's a lot of stocks out there, but I think the best way to play this is through the indexes. So I'm looking at the SPX here. We're at 2114. We kind of topped out at 2111. Hit some strong resistance there. So, again, if you look at the strikes here or the expirations, we've got our choices are: do we go out 5 days, which is next week, or do we go out 13 days, or do we go out further? I think depending on what happens through, this coming week with earnings, will kind of set the tone. So we could have some downside in the next week or two. Now, I don't want to go out 5 days. I don't think that gives us enough time, but I think 13 does for a short-term kind of downside play. And what I want to target, I'm just going here out 13 days, and I'm simply going to start by looking at a 30 delta on the downside. Very simplistic kind of trade here. I'm going to do a put debit spread. So let's go to the Analyze tab. I've already got it set up here. I'm looking at the 1985-1980 puts for about $1.10 right now. And if you look, I set this to the expiration is 2 weeks out, which is here. And what I'm looking at is $1,100 cost if you do 10 contracts, and a right at $4,000 profit if we are below this point within the in the next 2 weeks. Right, so that's a pretty good risk-reward ratio. I like something like that. Now you guys can play around with these strikes, and move this thing as you want, but the higher you go up, the more expensive it's going to be. And my thought process was really that we've already had this big run up, to get to this point. Could we keep going up to here? Sure, we could. But do I think we will? No. And it will depend on earnings. So if we come in and earnings start really, being awesome and knocking the cover off the ball, this trade is not going to work. But I just want to give you, this is more than the specific trade, more of a thought process of what I'm trying to do. I'm just trying to catch a 1 or 2 day, or maybe a 3 or 4 or 5 day move, to the downside in the S&P, because it's coming. I don't know if we continue to go higher, but I think the short covering rally that we've kind of had, I think the shorts are all sold out, and I think the buyers may be kind of exhausted here. We've had a pretty good run going into earnings. That's not really a good setup going into earnings. So that means the earnings have got to be spectacular. So if they're not, we're going to see some downside. So something like this could take advantage of it. Again, just kind of want to give you an idea of what I was thinking about. And again, you could play around with these strikes. You can make them a little wider. You can also tweak your risk here by doing a different number of contracts from 10 to 6 to 5 or something like that to reduce your risk here. But I think something like this works. If you move the strikes this way, it becomes a lot cheaper, and your pattern looks more, more like this. And you go to a $500 loss and a $10,000 gain, but the chances of getting over here are much more slim than getting to here. So think about that when you're trying to set something like this up. And again, I like something like this. It's about a 1 to 4, $3,900 profit to $1,100 max loss if you held it to the very end. Now this thing will start accelerating pretty quickly, probably toward the end of next week. So this is a good way to play some downside in the very short term. So take that and again, tweak the strikes if you would like. I think something like that could work nicely. Be careful here. This market. This is a we could continue higher before we go lower. So maybe and I'm actually doing this on Saturday, so I won't know exactly until Monday we come in. If we come in Monday and we're up higher, maybe I do a half position. Maybe I do 5 contracts at $1.10. If it keeps going higher, maybe you can add another 5 at 50 cents or something like that. Or you wait and move your strikes up 5 points or 10 points if we get a big rally. Now the bond market's closed on Monday. I think it'll be a light volume day in the market. But again, hold on. Put your seatbelts on, because next week's going to be earnings getting in full swing with all these banks. It's going to be a big week. So keep everything kind of tight and be nimble next week. And good trading, guys. Thanks. I appreciate it.